The real estate investment trust VICI Properties just released their latest quarter's earnings, but if you only look at the key highlights, you're going to miss out on some very important details. This does not tell the full story. Now, what we can see is Q4 FFO came in at 58 cents, which was a miss by about 9 cents, so a somewhat significant miss, and revenue came in at about $976 million, up about 4.7% year over year, which was a beat by $6.76 million. So we saw mixed results on top and bottom lines, but we can see the stock is currently up about 1.33%, and if we look at just the last month alone, the stock is actually up about 4.64%. So why is the stock trading upwards after this mixed results, especially after a decent sized miss on FFO? And to understand what's really going on here, we're going to have a little lesson on real estate investment trusts. Now, before we do that, let's look at two of these other key highlights. Start off, we can see adjusted funds from operation increased 5.4% year over year to about $601 million, and on a per share basis, it increased 3.6% year over year. So there's a pretty big difference in AFFO and the amount it increased versus the amount increased on a per share basis. Why is this? Well, if we jump over to the stock screener, let's go ahead and come up here and plug in VICI. Again, all this data will automatically load in thanks to the help of the ticker data add-on in Google Sheets. And like always, if you'd like to download any of my spreadsheets and also get access to that ticker data add-on, then you can head over to tickerdata.com at the link in the description. Now, what I want to point out is if we come down here and look at shares outstanding for VICI Properties, we can see it looks like nearly every single year they're issuing new shares. So technically they are diluting shareholders, but this is quite normal for real estate investment trusts. We have to remember by law they're required to pay out 90% of their earnings in the form of dividends, so they have pretty much two ways that they can grow. One, they can take on new debt, or two, they can issue new shares. And we can see when interest rates were really low, they were electing to take on debt, but as interest rates went higher, they started issuing new shares instead. But from 2023 to 2024, they did continue issuing new shares, but the share issuance did slow down. So that's the reason that we can see the difference in AFFO versus AFFO growth on a per share basis. It's going to be a little lower because they did issue new shares. Now, here's something that's positive about this company. We can see they got their credit rating upgraded by Moody's, and they also issued a stable outlook. So that's a great sign. So while these two key highlights are good news for the company, it still doesn't paint the picture with what's actually going on. If we take a closer look at what's going on with FFO per share, which again, we saw a pretty big miss there. If we read this key highlight, Q2 2024 adjusted FFO per share came in at 58 cents, missing the 67 cent consensus. And so this led to a year-over-year decline. But what we have to understand is this mainly reflected on an absolute basis the $157.7 million aggregate change in the CECL allowance over the same period. Now, if you're not super familiar with REITs, you probably have no idea what that means. But it's very important we understand what's going on here with VICI Properties. CECL stands for Current Expected Credit Loss. And this is a standard accounting rule requiring companies to estimate and record expected credit losses on loans, leases, or pretty much any other financial assets up front rather than waiting for the actual losses to occur. So what this means in the case of VICI Properties is if they expect even a very small increase in risk, such as a potential tenant default, then it has to increase its current expected credit loss reserve. And what that does is it directly reduces reported earnings and adjusted funds from operations. So what this means for VICI Properties when it actually comes to their adjusted funds from operations is it basically means no actual cash outflow happened. This is simply a paper adjustment. So the AFFO decline is largely accounting driven, meaning it doesn't necessarily indicate that anything changed with VICI's core business. VICI simply increased its CECL reserve, and what could potentially happen in the future if VICI decides that they over-reserved for credit losses. In future quarters, we could see them actually reduce this amount, which would actually end up boosting adjusted funds from operations. So you have to understand what's going on from an accounting perspective. The underlying business is actually still growing at a very healthy rate. They're basically just playing a risk mitigation game. So for a lot of investors, you might be wondering, why did they increase this? Are they worried about what's going to happen in the future? What's interesting about this, like we just saw, is they actually just had a credit rating increase, which again should give you even more confidence as a potential investor in this stock. So when I simply look at these two headlines for VICI Properties, it certainly does not tell the full story. This report was actually even better than it initially looked like. And on top of all this, REITs are actually trading at one of their most attractive valuations that we've seen in a very long time. And this was something I was just talking about in my free newsletter, link in the description. But REITs are currently trading at one of their lowest valuations since the global financial crisis. And you can see this charted out here. And what's interesting about this is the last time this happened, REITs nearly doubled the performance of the S&P 500 over the next 3 years. We can see in this example, VNQ, which is Vanguard's real estate ETF, had an average annual return last time this happened at nearly 22%, while the S&P 500 was about 12.5%. And here in just a moment, we'll talk more about VICI's specific valuation. But if you've never heard of VICI Properties before, there's a few key factors about this REIT that makes me absolutely love it. And let me be clear, there's a lot of bad real estate investment trusts out there, plenty of REITs that I would never invest in. But there's a few things that make VICI Properties different. If we go ahead and jump over to their investors presentation, I want to look at 3 key slides. Now, to start off, what are we looking at here? Well, key highlight number 1 right here. 100% of their contracts are triple net leases. And under a triple net lease, the tenant is required for paying things like property taxes, insurance, and even maintenance costs. So what this does for VICI Properties is it makes the cash flows they're seeing very predictable. They don't have to worry about all these other expenses. As an investor, I love stable cash flows. Not to mention, it can also lead to higher profit margins. Now, if we go ahead and scroll down, there's a few other things we have to point out. When we think about difficult times for real estate investment trust, I think about 2020. A lot of REITs were not able to collect their rent from their tenants, but look at VICI Properties. 2020 rent collection came in at 100%. I've said this before, but a REIT is only as good as the tenants within their portfolio. So if your tenants are able to pay at 100% through very turbulent times, that's a sign of probably a very healthy real estate investment trust. And then if we scroll down to the 7th slide, one of my favorite things about VICI Property is the CPI protection, or the inflation protection they have baked into their contracts. We can see 40% right now of VICI's rent roll has CPI-linked escalation for 2024, which basically what that means is if inflation increases, then the amount they receive in rent automatically increases along with this. And they're projecting that by 2035, it will be 90%. So when you buy VICI Properties, inflation isn't really something you have to be concerned about. So you're starting to see the things that make VICI Properties attractive. But what are the main risks to this business? One of the easiest ways to get a quick idea, or should I say a much more in-depth idea of what risk the business actually has, you can go over and look at their Form 10-K, the company's annual report. This is typically going to be a report that is hundreds of pages, but it's going to outline some of the key business risks. In fact, if we look right here, look at the table of contents, the risk factors for the business are one of the first things that come up. And I want to show you 4 key risks for this business that I think aren't actually something I'm too concerned about. So let's go ahead and scroll down and take a quick glance at this. To start off, they state we are and expect to continue to be significantly dependent on our tenants for substantially all of our revenues, and because our tenants are required to pay a significant portion of their cash flow from operations to us. Basically what they say is, in the event that has a material adverse effect on any of our significant tenants, could also have an adverse effect on us. Now, this is true for any real estate investment trust, and I actually go back to what we saw about 2020, 100% rent collection. So this is a very general risk they're talking about here, one that I'm not overly concerned with. If we keep scrolling down, we can see they say they're dependent on the gaming industry and may be susceptible to risk associated with it, including heightened competition, regulatory problems, or changes in consumer behavior and discretionary spending. Now, the outlook here is gambling is absolutely exploding, for better or for worse. And in fact, if we actually look at what's going on in Las Vegas, where VICI has most of their real estate, it's exploding in growth. More visitors are coming every single year. They've even had events like the Stanley Cup in 2023. They had the Super Bowl in 2024. They're also going to be hosting in 2028 the NCAA Final Four. And in 2023, they posted an all-time annual record when it comes to gaming revenue. So again, not something I'm overly concerned with. If we keep scrolling down, they talk about having a concentrated portion of our revenues are generated from the Las Vegas Strip, and like we just pointed out, this area is absolutely exploding with growth. So yes, there is some risk there because of that, but in some ways it's actually also an advantage. So those are the top 3 risks that the company actually states. So by now, you should have a better understanding with what actually happened in this recent earnings report, how this company operates. And so we have to answer the question, is VICI Properties trading at a good valuation at $31.11 per share? And to answer that, we're going to jump over to my REIT valuation spreadsheet. We'll go ahead and come up here and plug in VICI and hit enter. And all this data will automatically load in, again, thanks to ticker data. And there's 2 main valuations that I want to look at when it comes to VICI Properties. And to start off, we're going to look at the AFFO multiples valuation. And this is by no means a perfect valuation in the case of VICI Properties because there's really no company exactly like it. But by taking a couple of these companies, we can see the average price to AFFO multiple is sitting at 14.24, while VICI Properties is currently sitting at 13.27. So if we use that same average price to AFFO multiple, VICI comes to an intrinsic value of about $33.38, a little bit higher than that current trading price. But then the even better valuation, I think, in the case of VICI Properties is looking at them from a dividend discount model perspective. We can see the dividend growth rate for VICI Properties is currently projected to be about 3.75% in this model. So with a discount rate of 8.5%, we come to a dividend discount model price per share of $37.02, quite a bit higher than the current trading price, about 19% higher. And keep in mind, VICI Properties starting dividend yield currently close to about 5.62%. And if we look at the dividend history for this REIT, they have a very steady track record of paying out those dividends. They even paid them out in 2020 and were able to continue growing them, another very good sign. And like you already know, this was because they collected 100% of their rent in 2020. So if we look at the dividend safety, the AFFO payout ratio, the best way to judge a REIT's dividend payouts, it's sitting at about 76% forward-looking, which by all means is pretty healthy for a real estate investment trust. So from a dividend perspective, again, things look really good for this REIT. If we jump over to the output and average those two valuations together we just used, we come to an intrinsic value of $35.20. So if we use a 10% margin of safety, looks like our acceptable buy price is about $31.68. So we get a buy signal with a 20% margin of safety, acceptable buy price of about $28.16, which keep in mind, if we look at the past year, there's certainly been opportunities to buy VICI within a 20% margin of safety. So for me personally, I'm very happy to have VICI Properties in my personal portfolio, and I didn't see anything in this recent earnings report that overly concerned me. And with that being said, I think the valuation still looks pretty attractive. But go ahead and let me know what you think of VICI Properties in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.